The investment world has really changed in 2020, it seems. Retail investors have outperformed hedge funds. Risk tolerance has accelerated. Portfolios have grown for those in equities by a large margin. But many have forgot to ask, what got us here in the first place? You came here for the truth, so let me unveil that for you. We are going to party like it's 1999. That's right. Have no fear about 2000, because in 1999, you've got to party. And this is really a lesson that many have not learned. It is just like the housing crisis experienced from 2007 and onward, where all of the realtors, all the mortgage brokers, everybody in the business was saying, look the other way, we are having a good time. Don't stop the drinks, don't stop the music, don't be a party pooper, it's time to party. But of course that didn't end well. Today we are looking at some absolutely absurd statistics, and yes, I get it, this time is different. Oh yes, it really is. But we have to acknowledge why. That's what I'm here to do. With what you do with your money, that's up to you. There's nobody here on this side of the microphone telling you what to do with your money, but you've got to be aware of the details and why we got here in the first place. I have covered in numerous occasions how you look at the central bank balance sheet and you look at what's going on with the stock market. It is very clearly correlated, and that will probably continue to be the case until it doesn't. What's going to make that change? I have no idea, and don't listen to anybody that tells you otherwise. When you look at the central bank balance sheets and the amount of money that they have printed, it is completely absurd. I believe the Federal Reserve in the 2 videos ago, I think I just gave you an update on that. We are looking at the major central banks going over $7 trillion. I'll give you some updates around those today as well, looking around the world. We are going to talk about what's happening with investments in general, talking about economic factors. If I have time, let's go. Let's get into it right away. Bank of Japan total assets for Japan, you could see over the years they've been increasing. If I zoom in all the way down here, 2020, they have gone absolutely haywire, but they've been doing this for years and years. And you could see right here, it has also gone into this territory, accelerating dramatically. We don't know where they will stop, but when you see all the predictions, essentially they are going up and up and up, much higher, and then a lot of them start to plateau off. That's what the analysts think. I actually don't believe that to be the case. They really didn't at any point, but they have to say this, and then we actually get the truth at a later date. Looking at the ECB's balance sheet, I mean, same thing essentially. We're going over $7 trillion, actually euros in this case here. They have accelerated right through 2020 as expected. I mean, all central banks are doing the same thing. I don't just pick on the Federal Reserve, of course. You could look at them all, and they've all expanded at the most rapid rate ever in history. At the same time, they've been decreasing their interest rates, and largely when you look at all of the central banks and their actions, it's basically the same. Expand the balance sheets, cut the interest rate, and give away money as much as possible. Some central banks act like a hedge fund when you see what the Swiss National Bank is doing, for instance, but it's not very different from what the Federal Reserve is doing when they're buying corporate bonds. This type of thing is only meant to siphon away money from the average person, from the middle class, from everybody essentially, and bring that into the elite. The elite are not the 1%. Let's be very clear. The 1% is not part of that group. If you think that you're part of the cool club because you're in the 1%, my goodness, how blind are you? Big economic stimulus works, and that's a problem. Yes, it is a problem because, as they explain here in this Bloomberg article, now it's like a drug. They need it. Well, 2020 invited an unprecedented level of coordination between independent, I love that word, central banks and governments this year. If the global financial crisis taught economic policymakers anything, it was go early and go hard. The cost of hesitating proved too great. Now the world's most powerful central banks have expanded bond purchases about $17 trillion. Does that make any sense to you, to go this far in something that can't actually benefit the average person? Of course not, but people do not care. All they know is, well, the Federal Reserve is doing something. I don't really know what the Federal Reserve is, and that's fine, but that's what's happening. Look, the actual dollar, your currency, if you're in the US, look at it. Is not even a real dollar. It's a Federal Reserve note. It says it right on the money. On the back of it, they've got the pyramid. They are telling you, they are rubbing it in your face, and yet people haven't figured it out. Further along in this article, recent QE has placed central banks in deep and uncharted waters. My view is that these QE actions have been necessary to support the economy and hit the inflation target. Not even true, but they pose rising challenges to public understanding of the purpose of QE and ultimately perceptions of independence. This whole independence thing, they keep bringing it up, is so ridiculous and it irks me. Anyway, the question of central bank overreach started gaining attention in the aftermath of 2008 when the Fed, ECB, and the Bank of England deployed massive bond buying to keep interest rates at rock bottom levels. The BOJ began its experimentation around the turn of the century. With QE now so much broader, the dangers of blowback have multiplied. An arduous and uneven recovery is likely to make monetary institutions tempting targets for politicians looking to deflect blame, searching for more cash cows to milk, operating effectively as a third or fourth arm of government or as a de facto administrative state leaves monetary practitioners vulnerable. What I wanted to say about this is simply the fact that all central banks are acting in this way not to the benefit of the people. They are not doing this because the government has told them so. It's completely and entirely different. It is a different situation. The purpose of their activities is to use the crisis in order to actually take the money, siphon it away, and bring it into the hands of the elite. This has been documented over and over and over again. I did so in my first book repeatedly, but I know you don't have to get the book. You can see it and just study the history to figure out exactly what had happened. I mean, it's pretty obvious. Anyway, let's move on to the next one. I want to show you several charts because they're really going to break down exactly what's happening, the insanity of 2020 going into 2021. The Main Street inequality of 2020, U.S. private sector financial assets as a percentage of the GDP right now, 6.3 times. 6.3 times. But if we look at that, let's say after the 1940s, obviously a big deal, you go from there, from the 50s all the way into the 90s, it's within this range, all right? Within that range, and it looks like, let's just say around that 3. Now we're more than double that, in fact. More than double that. And this never came off that track. It continued, but now in 2020, it's accelerated so fast. And you could say, well, things are different now. They absolutely are. But when you see things get out of whack, there's always a reversion to the mean. This is a process in nature that cannot be disturbed. The Wall Street polarization of 2020, you could see for yourself how things really do change over the course of a period of, in this case here, showing you 20 years. Top 5 companies as a percentage of the S&P 500 market cap. Look at this. In the year 2000, Microsoft, GE, Cisco, Intel, and Walmart. 2020, Microsoft, Apple, Amazon, Alphabet, and Facebook. Look at how many of these companies didn't even exist back then or were in their infancy. Things have really changed. And as I have talked about previously, I think it was 2013, if you saw, Exxon was the top company in the world, and now it gets booted off the index. Not this index, but anyway, look at how things have changed. It's just incredible to see how in short bursts, relatively short bursts historically, how there's a lot of money that can move in and out of something. That's why I believe people that say if a correction comes in, and the term, by the way, should not be a correction because that's 10% and you wouldn't move your money because of 10%, but you start to see these periods of time where the market comes down and then, okay, it can come back up. But when the market comes back up, which stocks are going in that direction? If it's Exxon, you may have had a big problem. If you were waiting for a period in which they would become more profitable and there would be more investment going in that direction, you might have to wait a long time, and who knows what would happen along the way. There's somebody, though, that really stands to gain. Going back to the days of Standard Oil, when they break up these big companies like this, they actually tend to gain even more. That's what they're doing today. Oh, we're going to break up Facebook and that's going to solve all the problems. No, it's not. They're just going to become more powerful. And people, they watch the news, they watch all this information on the internet and so on. They say, we're going to get them, we're going to split that company up and we're going to do that. And then in the end, looking back 20 years, you realize, my goodness, they actually did become more powerful. And it wasn't a coincidence. It's all a coordinated effort. But I have to come on here and yell and scream when really, oftentimes, I'm preaching to the choir. I realize that, but I just got to get it off my chest sometimes. Now, I've ranted enough already in this video, so I'm not going to be able to get into it, but this Market Watch article gets into so many different indicators. Highly recommend checking it out. Links will be in the description under the sources. Valuations are crazy. US stocks are now valued at 184% of annual GDP. Warren Buffett used to say comparing stock values to GDP was a good rule of thumb guide to overall valuations. You can compare that and see how ridiculous it is to where we were before. I mean, come on. Early 2000s peaked out at 140%. That's just to give you an idea. Meanwhile, measured against the replacement cost of their assets, a metric known as Tobin's Q, US stocks are nearly 4 times their average historical levels. You see some of these stocks like Tesla, like Amazon, and others, and you have to wonder what exactly could make this actually trend upward as it has. There are an infinite amount of excuses, but it has gone beyond where you would say, okay, this is optimistic for the future. The market is forward looking. I think we're past that at this point. Whether that means the market comes down or goes up, that's besides the point. We are just much further than anything historically. Things are topsy-turvy when retail investors outperform hedge funds, not by a little bit, but 14-1. Unbelievable, but you could see that for yourself right here. This is just something that has been trending, but you got to understand a little bit more to this. It's not just that the retail investors and what they do are moving markets and so on. No, the retail investors, they're using things like Robinhood, let's say, and that information is sold off to companies like Citadel, who use that information along with their high frequency traders to be able to profit off of what's happening. So they see what the retail traders are doing, they copy those trades, they front run them, they are actually gaming the whole system. That's a whole other point. And then they really are the driving force behind that. That's one part of it, of course, but you look at it and you see there's really a shorter and shorter, or let's say less and less amount of investments taking place today, and that's never a good thing. You want to have some serious spread happening. The breadth just isn't there in where it used to be, where you look at certain companies and certain sectors that are just performing so poorly today, and we'll talk about that more in a second. Gold prices have increased with the amount of global negative yielding debt. The reason I mention this is quite important because previously you may buy a bond because you can get something like, let's say, 3% on your money, 5% on your money, and it's quote unquote guaranteed. Well, what if in this case your money wasn't so good anymore because you're getting negative yield? Well, many investors are looking at gold because they might say to themselves, well, maybe I won't get any money back, but at least I'm holding on to it. So it's being used as savings, which I completely agree. That's where it has its best opportunity, not just over a period of a year or 2 years or 5 years or 10 years or 20 years, but we're talking about thousands of years, holding and maintaining value passed down generation to generation. So important, especially in certain cultures. And I think that investors have finally picked up on that. We'll see what happens longer term. Certainly this year it has done well overall, not as well as some of those high-flying tech stocks, but it is something to watch. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. By clicking a button on your screen, you helped the guy who created this video. Thank you. If you want to actually learn about e-commerce, you're interested in making money online, you can do so for free, theamazongps.com. If you want to read, well, yes, that's right. If anybody still reads out there, I got 2 books that you've got to see. You've got to see. Maybe you don't want to look at them yourself or you already have them. You've got friends, family, and others around you that need this information. So definitely check it out at the link in the description. Or if you want the audiobook, that's available at themoneygps.com. Hey, have you watched this video yet? Probably not. Only about 10,000 people as of this recording have seen it, and for some reason it just didn't catch the viewers. You definitely want to check it out. It has so much detail in it, and I'm just a little bit disappointed that for some reason it didn't hit the radar of a lot of people. Click on it. I'll see you there.